Well, good morning, everyone. Welcome to our call titled The Times They Are A-Changin', The Case for Energy Equity Investment Now. I'm Toby Lofton, and I'm joined by my teammates and fellow portfolio managers, Trip Rogers, Tim Dumois, and Ben Cook. Over the course of the next 25 minutes or so, we plan to share with you what we believe has changed fundamentally in energy and why that is relevant to you right now. At the end of our prepared remarks, we will answer a few frequently asked questions, but if you have additional questions, you can email them directly to me at the following email address, tlofton@bpcfunds.com. That's TLOFTIN at Bravo Papa Charlie Funds plural.com, and we will follow up with you individually. We also plan to send the replay details along with the presentation to each of you shortly after the call. So let's get started. So these are the key points we plan to hit today. The first one, I'll start right out of the chute, is with respect to oil prices. We see tightening fundamentals. Well, I'll throw the first question to Trip. What exactly have we seen change that leads us to that conclusion?
Thanks, Toby, and thanks for dialing into the call. We wrote a piece on this topic last week titled "Oil is Getting Even Tighter in Here." You can find that on our website at bpcfunds.com under the Insights tab. And the main conclusion is the change we're seeing is that we see a very tight supply conditions for crude oil in upcoming months. The result, we believe, is the increased likelihood of even higher oil prices in the near term. Granted, crude fundamentals saw some softness this summer, with oil prices pulling back somewhat. But we would view this as simply a timing mismatch between what has been an increase in Saudi barrels hitting the market and our expectation for a dramatic fall in Iranian exports in upcoming months. So first, let's review how we got here. OPEC began a policy of production cuts on January 1st, 2017. It was actually an expanded OPEC group that importantly included Russia. Their policy was to take 1.8 million barrels per day out of the market, with the objective of reducing what were at the time very bloated global crude inventories. The policy had a delayed impact because Saudi and Russia had actually built up inventories into the cuts, but inventories started to fall really in spring 2017 and consistently drew for about a year until OPEC was successful in reaching their goal of achieving inventories at the 5-year average. The blue mountain on this chart represents the inventory spread versus the 5-year average. You can see that being their goal being accomplished earlier this year. So most recently then in June, OPEC met again and they decided to reverse their policy and increase production by 1 million barrels per day in order to counteract a dramatic fall in crude production from Venezuela, given the chaos in that country, and to prevent a price spike from the cartel over-tightening. The new policy has largely relied on higher production from Saudi Arabia, since Saudi is thought to have the majority of spare capacity in OPEC. And if you look at the next slide, you'll see that Saudi exports and Saudi production has risen dramatically following the June OPEC meeting. This led to some softness first in the international markets in July, illustrated by negative time spreads for Brent crude, or in other words, slight near-term contango in the forward market. Then in August, we began to see evidence in the weekly inventory figures that the added Saudi barrels were showing up in the U.S. That caused some weakness in the WTI that we saw earlier in August. But most recently, we've seen some bounce back in crude pricing as the tracking data has shown that Iranian barrels have already started to leave the market ahead of the additional U.S. sanctions, which go into effect on November 4th. So our key point is that we think the market gets extremely tight in upcoming months as additional Iranian exports are curtailed. We think the impact of this is particularly large later this year after the usual boost in demand following the fall refinery maintenance season. And just given the severity of the sanctions, we see Iranian production falling by 1 million barrels per day to 1.6 million barrels per day from the recent levels of peak production, as shown in this chart on the right. The 1 million barrels per day decline would equate to the same level of a decline that we saw in 2012 with the prior sanctions, and that would represent the Iranian exports going to Europe, South Korea, and Japan. The larger number of the range, the 1.6 million barrels per day, we think is still very realistic. That would result from curtailments in Iranian exports to China and India, which are the two largest importers of Iranian crude. It's interesting this week that ahead of Indian and U.S. talks, India is claiming that it will not shut out Iranian imports, although the August data indicates they have already cut back. Also, we would note that Energy Aspects, a consulting group we hold in high regard, expects a more aggressive 1.5 to 1.6 million barrel per day decline, which would lower Iranian production well below the levels of the prior sanctions. The Trump administration has announced plans to release 11 million barrels over October and November from the Strategic Petroleum Reserve, or the SPR, to offset the Iranian decline and prevent a spike in fuel prices around the upcoming election. We would view that as only having a short-term impact and not being near enough to offset the supply decline from the Iranian barrels. If released over 2 months, the 11 million barrels from the SPR would have an impact of only about 200,000 barrels per day, or less than 20% of the decline of the Iranian exports at the low end. Apart from the SPR, the main question is how much can Saudi really ramp production from here, especially if they reach an agreement with Kuwait in the near term on resuming production in the neutral zone. In short, while Saudi claims to have 12 million barrels per day of capacity, we think for production is well below this level, is capped well below this level, given that many of their oil fields are thought to be in structural decline. Interesting conclusion you might draw from the Saudi Aramco IPO being pulled last month is that the kingdom may not really want to reveal that they have less spare capacity than the market thinks. Also, I think it's important to remember that the Saudis are still very much tied to the oil price. It's estimated they need $70 to $80 barrels price to balance its budget with its expanded social programs and with its higher military spending. But let's even assume that Saudi can ramp from here. There's still just not a lot of spare capacity left with OPEC, as you can see in this chart. Moreover, there seems to be significant supply risk countries like Iraq, Libya, and Nigeria, which are all producing near the recent highs, but all three of those also have political issues that could severely pressure their oil output in the near future. You then combine this with constrained production out of key parts of the United States, namely the Permian Basin, which we'll talk about in a minute, not to mention some supply risk in the next few months from hurricane season, as well as falling production in other key oil-producing countries like Mexico and Brazil. And the clear conclusion is that the supply side to oil should be very supportive to higher oil prices in the near term. So we get the question then, okay, that's great about supply. What about demand? And what about particularly the risk of demand destruction from emerging markets as a stronger U.S. dollar makes oil pricier for those countries? The next slide has a lot of figures on it. I won't go through all those, but I do want to point out the consensus figures from the reporting agencies. Those would be the EIA, the IEA, and OPEC. They estimate demand to grow 1.6 million barrels per day in 2019, or about 1.5% global growth. That would result in flattish inventories after some inventory draw in 2018. 75% of the demand growth from oil is coming from non-OECD countries or emerging markets. The key point we want to make here is that the magnitude of the supply drop from the Iranian barrels leaving the market, even offset by the rise in Saudi production, provides a significant cushion to a potential drop in demand. So we lay out here two scenarios. The first one is we assume the lower end of our expected Iranian drop in exports, the 1 million barrels per day drop. This would allow for growth from emerging markets to be cut in half and global inventories still remain flat. In the second scenario, we assume the higher end, the 1.6 million barrels per day cut from Iran. Under that scenario, you could have a no growth scenario in emerging markets and still have no inventory build. So just in summary, if you dissecting numbers here, you can kind of get a feel for just how significantly supply should be cut here in the near term. And, again, how much cushion we have even if you were to have some decline in demand. So, again, we see a tight oil environment developing in the near term, and that's supporting prices.
Thank you, Trip. That's good. So our next topic is the short-sighted market view of Permian activity. So we've been watching this unfold for months now. What has changed recently that leads you to the conclusion that the market is viewing it short-sighted?
Yeah, thanks, Toby. I'll take that also. I'm going to refer back to another piece we wrote in July, which is also on our website, and that's titled, "When Will Completion-Exposed Oil Equities Discount Permian 2020?" And the opportunity here relates to another timing mismatch, we think. We believe the market has taken a very short-sighted approach to many oil equities, particularly oilfield service, as it relates to constrained production due to a shortage of pipeline takeaway capacity, especially in the Permian Basin. And the change here is that we're going to see an abundance of takeaway capacity being added to the market and come online in 18 months from now. As illustrated on the black line in this chart on slide 10, the Permian Basin has been the growth engine for the U.S. shale production in recent years. It's growing from less than 2 million barrels per day a couple years ago to a current rate of 3.6 million barrels per day. Throughout this year, it's become increasingly obvious that this level of growth in the Permian has resulted in a shortage of pipeline capacity to transport crude either to the Gulf Coast or the Cushing, Oklahoma hub. This is illustrated the black line showing estimated production being above the colored bars, which represent pipeline capacity starting earlier this year. For producers that don't have firm transportation or FT on pipelines, the result is that their oil is stranded in basin and priced well below crude at the Gulf Coast or at Cushing. The next slide shows the differential between crude price in the Permian or at Midland and that at the Cushing hub. That's also called the Mid-Cush diff. You can see this is blown out to around $18 a barrel. So again, that means that producers with unhedged production in Midland without dedicated space in the pipeline are currently receiving an $18 price discount to the published WTI price. So to little surprise, stock prices for Permian E&Ps without much FT or without hedged production have underperformed. And in particularly, the oilfield service companies have taken more of a hit, particularly those that are exposed to North American onshore completions like pressure pumping, since it's expected that the lower in-basin oil prices should lead to a reduction in oil well completions. And this is happening. We're seeing many oilfield service companies like Halliburton yesterday lower near-term earnings guidance based on the softness they're seeing in the market as these completions are delayed. But again, the key point here is that it's a timing issue. We look back on slide 10, there's a tremendous amount of takeaway capacity that's being added in late 2019 and early 2020 that should dramatically reverse the current pipeline shortage. In fact, according to East Daily, at the current initial production or IP rates, it would take roughly 1,200 well completions per month to fully fill the expanded capacity within 6 months of the new pipes coming online. For perspective, Permian completions are running currently well under 700 per month. So we expect a reacceleration in Permian activity in 2020 and a strong recovery in earnings, especially for those oilfield service companies. And so herein lies the investment opportunity. We think that over the next several months, the market finally begins to look through this current soft patch and begins to price in a recovery in Permian activity for 2020. And on this slide, you'll see just that the short-term concerns have been most pronounced with oilfield service. The OIH, which is the oilfield service ETF, has seen dramatic underperformance, especially versus the price of oil. Again, we think this provides a great opportunity given the market's short-sighted focus and a change with takeaway capacity that's upcoming.
Thank you, Tripp. So our next topic has to do with the change in the E&P management teams, the exploration and production, the producer community, listening to the investment community, and a change in sentiment regarding return of capital and return on capital. So, Tim, can you help us understand what has changed with respect to the discipline focus to how they treat capital?
Yeah, so one of the most exciting changes we've seen in energy companies recently is a shift to capital discipline. So capital discipline simply means that an energy company spends within its cash flow and focuses on its highest returning assets to deliver improved returns on capital. And this is making these companies look very attractive as margins have expanded and free cash flow is ramping up significantly. And you can see that here in these two charts. So the chart on the left shows that average EBITDA margins are expected to increase from about 6% in 2016 to 66% in 2020. So this expansion is a result of not only an increase in oil prices, but also cost reductions. So these companies have continued to drive down production costs through technological and logistical improvements. At the same time, the move to capital discipline is serving to put a governor on CapEx, which is leading to a substantial increase in free cash flow estimates. As you can see in the graph on the right, where the group goes from about a negative $27 billion in free cash flow in 2016 to a positive $32 billion in 2020. So what are these companies going to do with all the free cash flow that they're generating? Well, some of them are using it to reduce debt in order to clean up their balance sheets, and others are reinvesting it into high return projects. But many of these companies have started to return capital to shareholders through share repurchases and dividends. And on this slide, you can see a list of exploration and production companies that have recently announced these shareholder-friendly corporate actions. Again, we think this move to capital discipline is a very positive development for the industry for many reasons. It could provide support to long-term oil prices by moderating U.S. shale growth within cash flow. It should help reduce liquidity and solvency risks as debt is paid down and balance sheet strength is restored. And it also provides shareholders confidence that generating strong returns on invested capital is the primary goal. Also, these changes are leading to energy becoming more investable through the cycle as shareholder-friendly policies are being implemented industry-wide. And as a result of these transformational changes and the constructive macro backdrop that Tripp discussed, we think the energy industry is looking more attractive both on a standalone basis and relative to other industries.
Thank you, Tim. So moving to our next topic, there's been a veil of complexity sitting on midstream equities for some time now. We are seeing that change. So Ben, do you mind sharing with us what exactly has changed and why we believe it's lifting?
You bet, Toby. Whether it's capital discipline, as Tim described, or more broadly, a move towards improved corporate governance, midstream management teams, too, are generally moving in a more shareholder-friendly manner. Probably the most significant change we're seeing is the general trend toward MLP structural simplification, which is significant because it's providing investors with not only improved transparency, but importantly, it represents an aligning of interests of managers with investors, which we see as ultimately reducing risks to distribution stability, a clear positive for investors. So how's the veil of complexity lifting? Historically, the impact of incentive distribution rights have presented a problem for LP unit holders. First, because IDRs represent a take on LP cash flows. And secondly, because IDR elimination transactions generally have historically meant, not always, but in most instances, an issuance of LP units, creating LP unit dilution, in some cases a cut to the distribution. So the inability of the market to predict the timing and the magnitude of these types of transactions generally meant that investors have had to appropriately risk the uncertainty associated with those transactions, which has led to an overhang on valuation, generally translating to a discount in equity valuation. And what we're seeing in the sector now is a recognition by management that simplifying structures and removing IDRs can be a potential catalyst to equity performance. Recently, Energy Transfer Partners announced a transaction whereby ETE, their partnership, and ETP, their limited partnership, would combine to eliminate their IDRs in a simplification transaction. On that announcement, ETE, the acquiring entity, rose 3% on the day of that news. And we recently saw the announcement of the creation of Altus, a SpinCo, which will be formed by Apache and Kayne Anderson. That will come public as a C Corp, free of IDRs. So longer term, we believe the appeal of an unencumbered, simplified company structure will attract investor fund flows, again, perpetuating the simplification trend we've seen recently. So putting numbers to this, so if we turn to slide 17, what we're doing here is compiling numbers with the help of Wells Fargo that illustrate the gradual shift away from the encumbrance of IDRs on the MLP investable universe. From a standpoint of the transition here, some have elected to convert to C Corps in the process, and others have elected to remain MLPs. But in either case, through IDR elimination, the burden of the IDR is diminishing as an overhang on the sector. Again, this is Wells Fargo data back in August of 2014. 53 companies composed the coverage universe, 87% of which were impacted by IDRs. Fast forward to the expected number by year-end 2018, and that number moves to a minority, or 46%, on a coverage universe of 41 companies. If you include those with IDRs that are likely to eliminate those structures in the next year or two, the number shrinks even further. So in our view, there's light at the end of the tunnel here. The bottom line is that we believe these issues will be confined to a shrinking subset of the industry's companies. And as these IDRs and issues of complexities fade, we envision a diminished impact on the midstream sector investment narrative, which should allow for greater emphasis on fundamentals, which in turn should ultimately attract capital into the group. On slide number 18, we also highlight a trend that we believe is consistent with a more shareholder-friendly manner of funding midstream business activities. As is evident here, the use of at-the-market or ATM equity issuance is clearly diminishing. The question is often asked, why aren't we seeing more ATM issuance? The answer is twofold. Companies that are able to self-fund are choosing to self-fund, recognizing the benefits of accretion that comes with reduced equity issuance. And then two, those that can't self-fund or access capital markets, public equity markets, are choosing alternative means of sourcing funding by issuing preferreds, engaging in joint ventures, or pursuing asset sales where the overhang associated with common unit dilution could be minimized. Either way, the evidence suggests companies are steering away from ATM issuance, which we see as a shareholder-friendly trend, and one that should continue, particularly as fundamentals in the industry and as company financial health continues to strengthen. Which brings us to our next topic covering midstream fundamental change. Slide 19, tailwinds for midstream growth. We believe we are continuing to see a change, or better yet, a fundamental improvement for the better across the industry. In slide number 20 here, we illustrate four key touch points of hydrocarbon consumption, where we are seeing tangible evidence of expanding demand for U.S. produced hydrocarbons. As we've discussed, the abundance of low-cost, reliably sourced hydrocarbons increasingly being demanded by domestic and foreign consumers is in turn driving the need for expanded infrastructure to facilitate oil, natural gas, and natural gas liquids transport. From our perspective, we see this originating in four key areas. Exports, and you can see in the top left quadrant, we're illustrating the export of U.S. crude oil, which since the repeal of the export ban, we've gone from exporting virtually 0 barrels a day to on average over 1.5 million barrels a day. The same is true for LNG and natural gas exports. Those have also increased dramatically. The petrochemical industry is illustrated in the top right-hand quadrant. We're seeing increased consumption of propane and propylene by the petrochemical industry. The same is true for ethane. Recent figures from the DOE as recent as yesterday highlighted significant growth in ethane consumption here in the U.S. and export as well. Natural gas continues to be a market share winner from coal as a power source or fuel source used in power generation. We're seeing increasing gas burn for power gen. And then in the bottom right-hand corner, we continue to see year-over-year growth. The trend perpetuate towards increased consumption of transportation fuels. And here we're citing vehicle miles traveled as a proxy for the consumption and increased consumption in gasoline. So growth in these respective areas, in our view, will continue to provide new build project and expansion opportunity for the midstream sector well into the future. Turning to key investment theme number 6, this is we continue to see compelling valuation. We want to spend just a few minutes shedding light on a variety of absolute and relative valuation metrics that we believe reflect an appealing midstream valuation disconnect from the improving and attractive fundamentals we just discussed. In short, we continue to see midstream equity valuation as extremely compelling, and particularly so in the context of the trend toward more shareholder-friendly actions regarding simplification and the improvement in the industry fundamentals, which we continue to see strengthening many of the company's financial health. So let's put some numbers to this. On slide number 22, we highlight the relative valuation differential between midstream companies and other subsectors. What's evident here is that midstream companies, whether they're C Corps or MLPs, continue to trade at a discount to their historical 10-year average. In both cases, 1.9 times enterprise value to forward EBITDA estimates. This is in contrast to many of the other energy subsectors and equity yield-oriented counterparts, utilities and REITs, which continue to trade at a premium to their 10-year historical valuation average. Again, in our view, we see a diminishing risk to distributions aided by simplification and strengthening fundamentals. And so we believe this valuation disconnect should ultimately revert back to historical norms to the advantage of the midstream sector. On slide number 23, current MLP yield is tracked by the Alerian MLP Infrastructure Index relative to other yield alternatives here. MLP is currently yielding 7.6%, which screens favorably relative to REITs at 4% and utilities at 3.4%. Suffice to say, it's illustrated here on the screen, but you're getting, more than twice the yield in the midstream space from relative to what you're getting in the Dow Jones Utility Index. On slide number 24, we illustrate midstream equity yield spreads relative to government and corporate yields. With regard to midstream spreads, the story is very much the same. Although we acknowledge that spreads have come in over the last 6 months given the uptick in Treasury and corporate rates, midstream equities nevertheless continue to trade at yield spreads that are wide to historical averages, which in our view suggests, again, sector attractiveness from a relative yield standpoint. On slide number 25, we focus on the enterprise value to forward EBITDA and yield differential relationship between midstream equities and the utility sector as tracked by the Dow Jones Utility Average. We make this comparison because we believe many midstream investors have migrated away from the volatility that we've seen in midstream equities and the distribution payouts of many midstream companies over the last several years to the utility sector. In short, the utility sector, as a result, has stolen some investor share or market share from midstream. When you look at the relative valuation proposition, we believe that there's a good opportunity for the midstream space to recapture some of that investor share. On the top right-hand chart, you can see the ratio of MLP valuation relative to utility valuation on an EV or enterprise value to forward EBITDA basis has dropped to historic lows. And the yield spread or difference between MLP and utility yield, as illustrated in the bottom right-hand quadrant, although narrowing recently, remains above historic norms. So again, in our view, the improving risk profile of MLPs, given industry fundamentals and changes in corporate governance, and a focus on the efficient use of capital and a focus on returns, we believe should shrink that valuation spread relative to utilities to the midstream and MLP's advantage.
Thank you, Ben. Moving to questions, and what we've done is actually pick what we thought were the most frequently asked questions. So I'll start with the first one. We've talked about the near-term tightness in oil, but can we as a team discuss the medium-term fundamentals for oil?
Yeah, thanks, Toby. This is Tripp. I'll take that. This could be quite a long answer, but so I'll try to boil it down to a couple key points that we think keeps oil tight for an intermediate term rather than just near term. First one is the impact of supply cancellations of large projects during the most recent downturn. And if you'd see, we saw a number of large projects being cut during the downturn of oil prices. We're now about to feel the impact of that. We have a slide on this in our most recent blog. But I think that we'll start to see that impact from these large projects not showing up in 2019 and 2020. And the second one would be something called IMO 2020. That is a new regulation from the International Maritime Organization that enforces emission standards beginning in January 1st, 2020 that are designed to curb pollution from marine vessels. The new rule mandates that low sulfur fuel be used to power ships or that ship owners install scrubbers that allow them to use the higher sulfur fuel. It's estimated that IMO 2020 alone could tighten the global crude market by 1.5 million barrels per day. This is a topic that's increasingly being discussed by the investment banks and Wall Street. We think this will have a big impact in the years coming.
Thank you, Tripp. So one of the other key questions is price of oil. Do you need $90 for the equities to work? So, Tim, will you help us with that?
Yeah. So it's a good question, certainly one that we get a lot. So while $90 oil would certainly benefit a producer's cash flow, we really don't think it's necessary to see meaningful upside in upstream equities. So we run valuation scenarios at a variety of commodity prices, and at a $65 long-term oil price, there could be 20% or more upside in some of these equities. So there is a significant margin of safety being priced in to the equities, with current prices implying lower than $65 oil long-term.
Thank you, Tim. Well, thank you guys for joining us today. We are right past the 30-minute mark, so we want to keep it brief as we said we would. We plan to send out a copy of the webcast replay details along with a copy of this presentation. And if you have questions, please email them to tlofton@bpcfunds.com. And we look forward to visiting with you individually and again on our next webcast. Thank you again. Bye-bye.